Hello and welcome to part 2 of the ISSB Corporate Reporting Webinar Series, a series of discussions about how companies can get started now preparing for the coming ISSB standards and meeting the needs of investors for decision-useful sustainability data. In this episode, we're turning to climate risk and the ISSB's proportionate and practical standard for companies of any size or stage of development. I'm your moderator, Neil Stewart, Director of Corporate Outreach for the IFRS Foundation. And I'm joined by my colleague, Rommie Johnson, ISSB Technical Strategy Lead for the IFRS Foundation, Joe Allanson, EVP Finance of ESG at Salesforce, Finance ESG, Verity Chagar, ISSB member, and Richard Manley, Chief Sustainability Officer and Head of Sustainable Investing at CPP Investments, and also the Chair of the ISSB Investor Advisory Group. Welcome to all our webinar participants. More than 4,500 registrants from 148 countries or jurisdictions. They include finance executives, accounting professionals, sustainability officers, investors, regulators, legal professionals, and academics. Last week in the first episode with Sue Lloyd, Vice Chair of the ISSB, we introduced you to the IFRS S1 standard, demonstrating the ISSB's investor materiality approach. In today's webinar, we're focusing on IFRS S2, the ISSB's standard for climate-related disclosures, looking at how it incorporates the TCFD recommendations and relies on SASB industry standards to help companies in any jurisdiction satisfy new requirements and give investors the decision-useful information that they're calling for. Next week, at a time more convenient for Asia-Oceania, we're turning to integrated reporting, disclosure quality, and internal control processes, with speakers including the Future Fund, Australia's sovereign wealth fund, and the CFO of Tata Steel from India. All the recordings and materials will be made available on the same web page that live listeners are on now. Thank you to all of the participants who filled in our advanced survey, and this really helped us focus on what you're most interested in and answer the questions that you gave us. So our agenda today is to hear from Rommie on just these topics that participants ranked. And then after a quick take on Salesforce and its pioneering example of evolving sustainability disclosure, we'll have a panel discussion with Joe, Verity, and Richard. And finally, Rommie will rejoin for audience Q&A. So please type your questions into the question box next to the video at any point. But just before we go to your presentation, Rommie, let's you and I tackle the most frequently asked questions from both the advanced survey and from last week's episode in this quick fire round. So the first one goes to you, financial materiality. Clearly, the ISSB's focused. Any plans to address broader materiality?
Wow, you gave me the tough one to start. So, it's worth mentioning that going all the way back to the consultation that the IFRS Foundation trustees did in 2020 to assess whether or not the foundation could play a role in sustainability disclosure, there's a pretty clear remit to focus on meeting the information needs of investors. And a big part of the reason for that is that there are other standard setters who either have done or are currently doing really important work to meet the needs of other users with other objectives. We're working with those organizations, and we'll talk a little bit about that today, to ensure that preparers and users have a coherent and comprehensive system of corporate reporting. But I think it's really important to note that our focus on quote unquote financial materiality does not exclude impact. So impacts can create risks and opportunities for entities through a variety of different channels, whether that's regulatory or social or market forces. So the two things are not necessarily mutually exclusive.
All right, let me take the second one. This is a common question we get. How much of the ISSB standards do you expect to be sector specific versus universal? And the answer here is that this is not either or. This is not an either or argument. As you'll hear in this webinar, the ISSB's approach to climate risk, for example, takes both an industry-based approach and a cross-industry approach to themes and metrics. Next one for you, Rommie. Will the ISSB's standards be mandatory for all companies?
Well, the ISSB is a standard setter, so it's up to jurisdictions to determine whether or not the standards will be mandatory under their purview, whether that's through a government agency or a regulator or even a stock exchange, for example. As you probably covered last week, as you probably heard last week in the first episode of this webinar series, IOSCO which represents regulators in more than 130 jurisdictions, has been very supportive of our work thus far and plans to review the standards when they're ready, with a view to endorsing them for adoption in those jurisdictions. And so, more to come on that, obviously. But I think it's also important to note that even where they are not mandatory, investors with global portfolios are likely to push for voluntary use to ensure that the global baseline of comparability exists across all of their holdings. So, and I'm sure Richard and others can speak to that at some point later.
Great. Let me do the next one. Hang on. Will assurance be required for disclosure using the ISSB standards? Now, the answer here is very similar to the last question, that it will be up to each jurisdiction. So our responsibility as a standard setter is making sure the standards are the basis of suitable criteria for assurance. In other words, that ISSB disclosure is assurable. As part of our work with jurisdictions, we'll be supporting them in determining appropriate assurance requirements. So, for example, if they look to phase it in over time, starting with limited assurance, and in identifying what should be assured. Last question in our quickfire round, Rommie. What accommodations are you making for small and medium-sized enterprises?
Yeah, great question. Well, so the short answer is a lot. We're really trying to be as pragmatic and proportionate as possible in thinking about this work. And so we really want to try to make sure that companies of any size or stage of development can apply the standards effectively, including smaller companies, those in particular industries that may not be as far along in emerging markets in particular, or anyone really that's less advanced in sustainability disclosure. And we'll talk later, I'll talk a little bit later about some of the ways in which we've tried to achieve that, whether it's through guidance or educational materials, or even working with jurisdictions to think through how they might scale and phase the requirements in their jurisdiction.
Okay, though that's the end of our quickfire round, and let's go now to a presentation from you, Rommie. With an overview of our climate standard, how it fits in with the sustainability landscape, and a reminder: Rommie Johnson is ISSB Technical Strategy Lead with the IFRS Foundation. So I'll hand it to you, Rommie.
All right, thanks so much, Neil. So we saw on that slide a few slides ago that folks are interested in an overview of S2, our climate-related disclosure standard. So let's do that here. There's probably no better place to start than the big picture here. So as most of you probably know, the ISSB was established to address a pretty clear market need and filling in sort of the information gaps in corporate reporting that would help provide a more consistent and holistic and coherent view of a company and how it creates value over time. The work that we're doing with the ISSB is intended to be a complement to and to even sit alongside financial reporting. And collectively, they would form sort of the bedrock for investor decision making. The two boards, the ISSB and the IASB, are independent, but they will collaborate, and in certain ways have already begun to ensure that there's connectivity and compatibility among their different disclosure requirements. But it's also important to note that the ISSB's work is gap agnostic, and so it can be applied in any jurisdiction. Next slide, Neil. So you probably also know that in March of last year, the ISSB issued two exposure drafts, one on general requirements for sustainability-related disclosure and one on climate-related disclosure. What you may not know is that in the second quarter of this year, the ISSB will issue two standards based on those exposure drafts, and we've been doing a lot of work over the past 6+ months to get there, and we'll talk about some of that. Now, our focus today is on the climate related disclosures, but the key to getting started with that, with those disclosures, is the general requirements. And so I just want to quickly touch on that, even though it was covered in more detail in the previous episode. So as you learned then, S1 really, the general requirement standard really establishes the global baseline by setting out the general requirements for disclosure of information about all sustainability related risks and opportunities, along with some really key concepts that entities would apply in making those disclosures, as well as the ones that they would make in accordance with the climate-related disclosure standard. Things like how to think about reporting boundaries, how to achieve fair presentation, how to really articulate the connectivity between what's happening in the sustainability disclosures and what is represented in the financial statements, how to think about comparative information year over year, et cetera. All of this is designed to help ensure that companies are prepared to meet the needs of investors for decision useful information that, including climate-related information that is comparable, reliable, timely, understandable, et cetera. Next slide, Neil. So let's talk more specifically about S2, which is the climate-related disclosures standard. So S2 takes those general requirements that are set out in S1 and takes them a step further and helps companies think about how to apply them more specifically to climate-related risks and opportunities. The standard requires the disclosure of information about physical risks. So in other words, those that may be associated with things like extreme weather events that are increasing in frequency and severity. Transition risks. So for example, those that may be associated with regulatory forces or market or technology forces, or even those that might create reputational risk for an entity. And then finally, for information about climate-related opportunities, which can, I guess, be associated with any of those things. It's also really important to note here that to help companies get started, S2 incorporates key elements of some really familiar frameworks, including the TCFD recommendations and the SASB standards. So we'll talk a little bit about that in just a minute. So let's talk about the objectives of this standard. So essentially, it's to meet investor information needs. But what does that mean? Well, it's to help investors answer questions like, what are the risks and opportunities that an entity is facing related to climate change? What are the implications of that for the company's financial position, for its financial performance, for its prospects looking ahead? What are the implications for its business model and its strategy? How is it responding to those risks, and how might it need to respond if if the reality sort of materializes in a way that it's not anticipating? What is its capacity to adapt as competitive conditions change along with the climate? So if we go to the next slide, we'll talk about, in order to achieve those objectives, how of the standard, how S2 incorporates key elements of TCFD and SASB. So first off, this incorporation of these frameworks gives companies a familiar starting point, which we think is really important, enabling them to build on tools that they already use today to power their reporting. We also think that this combination really enables a powerful combination of information, qualitative and quantitative information, industry-based and cross-industry information, historical and forward-looking information. We think we really like this mix of different types of information because we think it enables investors to develop a more robust understanding of not just what a company's stated strategy is or what its plans are, but measures of how effectively it's implementing that strategy, and not just data points in isolation, but information about the context in which performance was achieved. Let's move on to the next one, and we'll talk a little bit more in depth about this TCFD structure, which I think is probably familiar to many of you, if not all. Governance, strategy, risk management, and metrics and targets. This structure and this framework has been widely adopted, including beyond climate, for a really good reason, and that's because it represents 4 key aspects of how companies operate, and in particular how they oversee, plan, manage, and monitor their interactions with their external environment, including the various sources of value on which they rely, whether that's financial capital, natural resources, human capital, social relationships, etc. And of course, those interactions create impacts and dependencies for the entity, which can then give rise to risks and opportunities. So in terms of thinking about how the standard requires disclosure about those risks and opportunities, let's look at some of the key features. So within the TCFD framework, if you kind of go one level deeper, particularly within the strategy pillar, so to speak, for these first two, there are some really key things that we're asking companies to provide information about. So first, how are they navigating the transition to a lower carbon economy? Investors increasingly want to know not just what a company's ambitions are, what targets it might be setting in this area, but how do they plan to achieve them? What are they actually doing? In what ways are they responding? Including to what degree any plans that they may have put in place rely on the use of carbon credits. Secondly, how resilient is the company's strategy and business model to a range of plausible scenarios, particularly given the uncertainty associated with climate change? Again, what are the implications of those different potential scenarios? How would the entity need to respond if things played out in a way that it was not necessarily anticipating? And what is its capacity to be able to do that? And then finally, the last item here, greenhouse gas emissions, which we'll go into in more detail on the next slide. So greenhouse gas emissions, as you're probably all aware, is pretty well established as an impact metric. It's also increasingly useful as a proxy for transition risk exposure, particularly in jurisdictions where emissions are directly or indirectly regulated or priced or otherwise. S2, the climate-related disclosure standard, requires the disclosure of scope 1, 2, and 3 emissions where that information is material. And as a starting point, S2 requires entities to use the greenhouse gas protocol to measure those emissions, which is by far the most widely used method around the world. We've also provided some accommodation for companies who are required to use a different method, whether that's by their relevant jurisdictional authorities or otherwise. And so there's some accommodation there for that situation. But when it comes to disclosure, we've taken the greenhouse gas protocol and built on it in a couple of important ways. First, with regard to scope 1 and scope 2 greenhouse gas emissions information, we've asked entities to disaggregate their GHG inventory to provide separate disclosure for the consolidated accounting group, which allows investors to do a direct read across from the financial statements. And then for scope 3, which we'll cover in a little bit more detail in a couple of slides, we've provided some significant guidance and reliefs to address questions about the quality and availability of the underlying data that entities use to prepare those disclosures. So before we get into that, I just wanted to maybe frame that discussion a little bit and some other things a little bit with kind of a reminder that all of our work and all of the work of the ISSB is guided by market input, including the work we've been doing this past 6+ months, like I said, to finalize the exposure drafts. So the feedback you see here on this slide was received during the 120-day comment period that we held last year. And all of this feedback and more has informed and guided the ISSB's redeliberations. So a lot of that feedback was really focused on how the ISSB can try to strike an effective balance between meeting the information needs of investors while also recognizing some of the practical realities on the ground. The fact that companies have different starting points, different circumstances, different levels of ambition, and certainly different capacities for making progress. So with that sort of framing, let's talk about some of the ways that we've tried to achieve that balance, starting with scope 3 emissions. So with scope 3, investors told us that it's critical information for them to understand the transition risk to which entities are exposed. Companies acknowledge that it's very important, but they also pointed out that there are some practical challenges. So we have done a few things to try to get the balance right there. First, we've developed a framework for navigating some of the challenges that are associated with data availability and data quality. The framework that we've developed uses concepts that'll be familiar to corporate reporting professionals, which we think is important in giving them comfort that we're not asking them to do the impossible here. We've also implemented a couple of reliefs that we think are very pragmatic. One that allows a temporary exemption for scope 3 information to ease the transition. And there will be a little bit more discussion of that in our February meeting in a couple of weeks in Montreal. So I encourage everyone to tune into that on the IFRS Foundation website. And then the other one, which is focused on providing a little bit of accommodation for situations in which companies rely on data from their value chain partners that may have different reporting cycles than they do. So these are just a few examples of how the feedback that we received has really shaped our work and the ISSB's work to try to achieve that balance that I was talking about between the benefits to users on the one hand and the costs and efforts required of preparers on the other. By no means are these the only examples of things that we've done in this regard, and they're certainly not limited to just greenhouse gas emissions. For example, the other key features that I mentioned with regards to climate resilience, we've required companies to use an approach that is commensurate with their circumstances, really trying to create an on-ramp for companies, but also put them on a path toward really building their capabilities and strengthening their disclosures over time. So one other key way that's worth mentioning that we've been trying to strike that balance is by pursuing interoperability with the sustainability reporting standards that companies use, whether that's those that are required by the jurisdictions in which they operate, or whether those it's the standards that they may use widely on a voluntary basis. So we have a jurisdictional working group comprised of members from China, Europe, Japan, the UK, and the United States, which also has IOSCO as an observer. They're working, and we're working with them to ensure that the global baseline meets the needs of investors and has a good, effective interoperability, reduces the duplication, and essentially improves the efficiency of the reporting system. We also have a sustainability standards advisory forum with jurisdictions from around the world. We're holding regular bilateral engagements with them to ensure that what we're developing is truly global. And then finally, I would mention that we have a memorandum of understanding with the Global Reporting Initiative, GRI, which we're hoping to operationalize a bit more fully in 2023 to maximize the interoperability between our two sets of requirements. And speaking of 2023, moving on to the next slide, a major focus of our work plan this year, before I wrap up, will be supporting implementation and application of S1 and S2, but also capacity building to enable adoption around the world. And so what you see here on this slide is a list of the guidance that we're currently developing to support preparers in applying the standards right out of the gate. This will be issued alongside the standards to support application. But this is only a start. This is, dare I say, the tip of the iceberg. As we move into the next phase of work, we'll continue to build out the resources available to preparers and users to ensure that the standards become embedded and as useful as possible. And in that work, I think we're going to really strongly continue to rely on the invaluable engagements and input of our great stakeholders like all of you here today. So for all of your past support and for all of your support that's still to come, I just want to say thank you. And I guess I'll leave it there, and we'll do some Q&A later. So for now, back to you, Neil.
Rommie, thank you very much, and I'll ask you to join us again in a few minutes. You can take a break now, but we're going to go now to Joe Allanson from Salesforce. And Joe is Executive Vice President of Finance ESG, formerly Chief Accountant and Controller at Salesforce, and Joe is also a board member of the Value Reporting Foundation. And so just before our panel discussion, Joe, we often hear about the ESG journey that companies are on. So tell us how Salesforce has been a trailblazer on that journey.
Well, Neil, thank you. And first of all, I wanted to express my gratitude to the ISSB for putting on and sponsoring this three-part webinar series. Also wanted to thank the ISSB members for all of their work on the S1 and S2 proposals. Those are standards that we sorely need here. But Neil, to your question specifically, Salesforce has been on this journey for quite some time. By way of background, we were founded in 1999 on the concepts of stakeholder capitalism, with the ideal that businesses are the greatest platform for change. And as we have learned in building a long-term, resilient, and durable business, companies have to do both well financially as well as do good for society and the planet. Climate risk is a material business risk, and trying to manage these risks can lead to opportunities that could create growth opportunities as well as value creation. So years ago, as we were looking at our reporting journey, what we witnessed was that we needed and we're missing a common language to communicate with investors around climate risk and the opportunities that it presented here. And this conversation on a common language had to do a lot around comparability, consistency, and reliability here. We also saw a strong need to merge this kind of information about climate risk together with our financial reporting that we do here as a public company in the US. So we aligned with the leading frameworks that you can see on the slide here. We were early adopters of SASB, we were early adopters of TCFD. 5 years ago, we actually started to include ESG information in our annual financial report on Form 10K. And then recently, we were able to extend the limited assurance work that our audit firm does to include scope 3. So all 3 scopes, 1, 2, and 3, carry a limited assurance review report from Ernst & Young. And then also most recently, we continue to raise the bar each year. Most recently, just a few months ago, we added climate into the agenda of our annual investor day with Wall Street industry analysts and other types of investors that were present. So we learned a lot from all these types of things. We also learned, Neil, that when you start these journeys, you're going to learn a lot. We certainly recognize that financial reporting benefits from 100+ years of maturation. And in this particular area of climate, maybe just a fraction of that here. But we guided our reporting strategy on a couple simple concepts of trust and transparency, Neil, and also the idea that we wanted to have the same quality and rigor in the processes and in the data as we do with our financials. But Neil, we learned a lot here. I can just tell you that we learned a lot here. All of the lessons have been really valuable. It has led to some incredible, informed, insightful conversations with users of our information here. And we also noticed that by doing this and getting a jump start, we really feel that we've eliminated a lot of the herky-jerky and drama. We've proved that we can do this kind of reporting without that type of drama. And really, I think we've prepared ourselves, Neil, that's here at Salesforce for the future of reporting.
Joe, thank you for that overview. That's a terrific introduction to Salesforce as a real leading voice in this discussion. I'll ask Richard and Verity to rejoin us now, and we'll have a panel discussion with them. Verity Chager is ISSB member. Verity previously held a number of ESG investment leadership positions before joining the ISSB, including at the California State Teachers Retirement System, CalSTRS, and also at BlackRock. And Richard Manley is Chief Sustainability Officer, Head of Sustainable Investing at CPP Investments, which invests the funds of the Canada Pension Plan. That's over 500 billion Canadian dollars. Richard is also a member of the Task Force on Climate-related Financial Disclosures, and he's a chair of the ISSB Investor Advisory Group. So let's start with you, Richard. We're talking about meeting the information needs of investors. So for you, speaking as investor, what do investors want in climate risk reporting, and why do you want it? How do you use it?
Thank you, Neil, and thank you for the opportunity to join you all today. I'd start, if I may, with what are our expectations of boards. It's very clear now that governments around the world have committed to the comprehensive decarbonisation of their economies by the middle of the century. And companies who are suppliers and customers are committing to the comprehensive decarbonisation of their business in the context of their value chain. So whether it's the prospect of regulatory change or evolving customer and supplier demands on the industry, it's clear now that boards need to ensure that their business will be resilient in the face of decarbonising global economies. And to the extent the economy doesn't manage to limit the worst of physical risks over the longer term, ensure that that business is resilient in the face of that macro outlook. So the reason we seek this data is we seek to understand that the board is discharging its duty to the company and ensuring that the executive team is putting in place a strategy for the business that integrates consideration of climate risks and opportunities that were outlined by Joe when setting strategy, its operational implementation, and importantly, how they communicate to the market. So we view climate reporting as the vehicle that the board uses to demonstrate that it is appropriately overseeing and counseling the executives of the business and ensuring that their macro strategy, their long-term strategy, is outlined, or sorry, is aligned with the macro outlook for the economies that they're operating in. So I don't feel people here need to take a position on approaches to climate change or ultimately the regulatory pathway, but there is a need for us as owners of the business to understand that the board is charting a strategy over the long term consistent with the risk and opportunity profile being projected onto the company.
So, Richard, it's really about performance, right? I mean, this is not about values, as we say, but about performance, right?
This is absolutely about ensuring that we understand the executive team of the company has identified the risks and opportunities. It's sought to mitigate the risks. It's sought to capture the opportunities in charting a course for the long-term sustainable financial success and security of our business.
Okay, let's turn now to the company side, and Joe, you again, and the metrics and targets section of the climate standard, the ISSB's climate standard, requires a company to take an industry-based approach in addition to the cross-industry metrics like greenhouse gas emissions. Does the industry-based approach, like the SASB standards or this approach the ISSB is taking, help you as a preparer?
Well, Neil, I'll just put it this way in a real concise type of conversation. It's double thumbs up here on this. You know, Neil, we are large proponents of this industry approach here. It's actually one of the reasons that drew us initially to SASB years ago was that industry approach. What we know are two things. What we know is that climate risk is a business risk, and climate affects each industry quite differently, in some cases disproportionately. We also know that investors are increasingly asking questions of us about and trying to analyze the health and performance and durability of the business as we address climate. We also know that investors like to compare. And so what better way to do that than to compare within companies within a peer group? So these are the things that we know for sure, Neil, and I think that's one of the reasons why we're so ecstatic about moving to that. As we know, most traditional financial accounting is a one-size-fits-all, but as you're just listening to what Richard was describing, it's very specific to a company and it's very specific to the industry in which they operate. And that's one of the reasons why we're proponents of this.
That's a really good perspective, and it's important because I think some of the market might view that industry-based layer as an extra burden, but in fact it reduces the burden. It focuses in on just that subset of relevant factors, which it makes for a cost-effective process of data gathering, assurance if required, reporting, and so on. Verdi, let's go to you now. And Rommie raised the point about greenhouse gas emissions, especially scope 3, and the challenges for some preparers, especially smaller ones or those in emerging markets, the challenges of where they have less control, less visibility, and the quality availability of data. There's also the challenge of scenario analysis, as he talked about, to report on climate resilience, on transition plans, climate-related targets, and so on. So what are some practical ways that companies can get started, phase into it?
Yeah, so over and over, we heard this was useful information we heard from investors that it's useful information and that some information is more useful than no information. And so there's value to investors in knowing where companies are starting from today. So for scope 3, for example, estimates are an acceptable way to begin to analyze your scope 3 emissions, and that companies should use reasonable and a supportable basis for those disclosures and those estimates, and explaining the assumptions underpinning those estimates. And they should use put in an effort and expend a cost that is appropriate for investor reporting, but not something that has to, take over every other corporate business objective. That's not what we're asking for here. We're asking companies to use a commensurate level of effort to provide the information that is useful to them and to investors to meet that investor need. And for scenario analysis, what that looks like is really a range of possibilities for meeting this requirement and talking about companies' resilience to that transitioning economy that Richard was talking about. So at one end of the scale, there might be really sophisticated models using expensive data sets, and that might be sort of the long-term objective for every company, perhaps. But at the other end of the scale, a very reasonable and acceptable level of performing scenario analysis starts with qualitative inputs and perhaps a narrative disclosure and description of a company's evaluation of its resilience to those potential qualitative scenarios. TCFD has some really helpful guidance to companies about how to think through those scenario analysis. And also, on emissions, Greenhouse Gas Protocol has some guidance for companies in getting started on Scope 3 across the value chain.
That's really helpful, Verity. Thank you. So, Richard, let's think past, look beyond greenhouse gas emissions and think about what are some other climate-related risks, opportunities in different industries that you want metrics on. We talk a lot about greenhouse gas emissions, but what about physical risks, water, supply chain issues that you're looking to understand?
Thank you, Neil. Yeah. Maybe just a quick word of note on the TCFD. As you mentioned, I sit as a TCFD member, and just a reminder to everybody, the TCFD is not a standard setter. It's a voluntary framework that was proposed by the FSB to support, industry in reporting its approach to identifying, quantifying, and managing climate risk. But the beauty of seeing the TCFD now integrated into the ISSB and the due process and the standard setting is the opportunity to actually propose metrics that should be reported by all issuers conforming. And these will be the metrics we've seen outlined in the first instance. And then there's the SASB standard metrics that we and investors have been using for years to determine specific areas of climate materiality for the business. And you've alluded to them. It's not just the emissions. We'd love to know the ease of abatement of emissions. Maybe I'll come back to that point. But we also need to look beyond the operations. So clearly there are physical risks that will directly impact the business. There are transition risks that will directly impact the business. But then for many, many companies, the physical risk in their operations will often be in their supply chains. Anybody that has some nexus with an ecosystem, be that soft commodities or a dependency on water availability for an industrial process, understanding the quantum of the exposure they have, the sustainability of that exposure under a transitionary regulatory intervention or under physical change over the long term, approaches they have to mitigating that risk and the potential impact on the business if that's not possible, is ultimately what we're seeking to glean from this. Now, I said it a reminder, we're looking to see here that the board is having the right conversation with the executives about the identification and mitigation of risk and the identification and capture of opportunity. So one sanity test I already remind people is, and this has been upheld, I think, by the SASB standards, and we're seeing it migrated into the ISSB standards here, is it should be quite easy for a rational observer to intuit that if a company performs better on this metric, it will either create value or reduce risk. And I'd say that has been carried through into the climate approach here, that these will typically all be metrics that we would expect the executive to be managing to, because there should be a clear expectation that if they improve performance, they'll enhance the value of the business.
That's a really good perspective, Richard, and a reminder too that many of these metrics can be found in the SASB standards. If a company is seeking to understand what are the relevant factors upstream, the ingredients, the materials that go into their product, or downstream, the design of the product itself, in terms of mitigating or coping with the transition, the metrics are there, industry by industry. Now, Joe, turning to you again, and do you see this as really as reporting and compliance, or within Salesforce, does the use of standards and frameworks really drive strategy and ultimately performance?
Well, Neil, I hope that all of the listeners of your virtual audience today really view these standards and frameworks as a risk reduction, value creation, value amplification narrative. I really hope that's the case here, because I think if people look at this as just a reporting compliance exercise, a check the box exercise, I really feel like there's been a really missed opportunity, and in some cases may potentially harm or destroy some of the value that the enterprise has created here. You know, Neil, underpinning all of this conversation here and the formation of all these standards and frameworks is this been building consensus for quite some time that the traditional financial statements do not contain all of the risks and opportunities that articulate and drive enterprise value. When I think specifically of climate, I really think that we're in the midst of the world's largest transformation opportunity here. And Richard was talking about that earlier, about kind of the things that are happening on the regulatory side here. But, you know, when I talk to Salesforce's customers, and we spend a lot of time with our customers here, well, what we talk about with them is that, you know, even in the grimmest of economic times, there are still growth opportunities that exist here. And certainly trying to tease those out is certainly very critical and important. But it's important to have, and climate is one of those opportunities here. Again, climate is one of those opportunities. It's a business risk, it's a business issue, but it is also a business opportunity here. And Neil, you know, it's critical for companies to have that climate action strategy, to really understand the metrics for success, the governance, all of those types of things. The reporting just really supports that narrative in order to have a very rich and deep conversation with investors who are partners with us in our future.
Richard, do you want to add anything on that? You know, I remember you saying that if this information is material to you as an investor, shouldn't it be material to management and the board? So do you want to add anything on how this is not just about reporting?
Yeah, and I actually reiterate Joe's point. If somebody is going to approach reporting this data as a compliance exercise, they're going to burden themselves with some incremental cost and probably some brain ache. But to Joe's point, they will fall short of capturing the value of engaging with this data. The reason to engage with this data is an expectation that it brought into the strategy setting, it brought into operational discussions. It is going to yield better decisions around corporate strategy. In the same way that having access to this is going to yield better decisions in our investment committees, there's a very, very real belief here that the reason to pursue this data, the reason to seek this data and integrate it into decision making is a belief that using a more expansive set of data upon which to make decisions, a more informed decision making process is likely to yield better decisions. And absolutely agree with that point. If you approach this as a compliance exercise, it'll be painful. If you approach this as a value creation exercise, it's likely to be very rewarding. We committed to TCFD filing ourselves in 2018. We completed that process in 2021. It took us a while. So to the extent people are debating when to start, my advice would be start as soon as you can. But I'll tell you, most of the value that accrued to us as an institution was in the process of the doing and the learning and collecting the data and repurposing that into how we set strategy rather than the reporting in isolation. So really, my view here would be, you know, use this as an opportunity to learn, to improve, to grow the organization, enhance the strategy, then it will pay for itself. If you use this as a compliance exercise, you might spend some time spinning your wheels.
Great, and that is really the first point to make when getting buy-in from senior management and the board. If you know, sustainability officers or finance executives are listening, that's a really good point, Richard. Verity, going to you, and I think we'll make this the last question of our panel discussion before Rommie comes back and we take audience questions. And Verity, can you talk about how the ISSB standards will fit with climate disclosure rules in the US, in the EU, perhaps other jurisdictions? What are the differences?
Well, our aim at the ISSB is to create a global baseline of information that is useful for investors. Investors largely have global portfolios comprised of companies from many jurisdictions. and they need to have comparable information, as Joe described, about identifying and comparing the risk exposure and risk management of different entities across their portfolio. You mentioned EU and the US SEC. I mean, those are two single region jurisdictions. The European Commission is a legislature. It sets policy, makes laws. And the US SEC is a regulator that requires disclosures to balance, investor protection and capital access within the US capital markets. And ISSB is a standard-setting body that creates standards that potentially other jurisdictions might require. So we are trying to improve transparency. Our objective here is to encourage transparency, and through that transparency, as Richard described, hopefully some useful thinking and then some useful conversations with between primary users of that information and the companies themselves.
Great. I think that's a really helpful contrast. Thanks, Verity. All right. So Rommie is going to rejoin us, and we're going to go now to audience questions. And reminder, the audience, live audience, can type questions into the box next to the video screen. And I have one first off for you, Rommie, a question from the audience. With the investor focus, does this mean the standard is unlikely to cover private companies?
Absolutely not. The standards, obviously are standards. They're useful for any entity. And as Richard, I think, was really usefully discussing, and Joe as well, when you think about this from a value creation perspective, it doesn't have to be something that you just think about as a reporting exercise. Even it's something that can help you sort of think through how is it that we're preparing as an entity to, as Richard said, manage the risks that we're facing and capture the opportunities that are available to us and capitalize on those. That's valuable to any entity, whether they are a private entity or otherwise. And so the short answer is no, absolutely not.
Good. Okay. Thanks, Rommie. So indeed, private companies can definitely use the standards, and we're seeing this in private equity firms as well, and in how they assess their portfolios and what they expect of their companies, and we see it in lending, right? And lending to private companies, sustainability linked loans are just exploding. Let's go to another question. I think that maybe I'd like to hear Richard's view on this. Rommie, the question is that Rommie made an interesting point earlier, saying GHG emissions have become a proxy for transition risk. And so I would like to hear a little bit more about that. And Richard or Verity, perhaps you have a view on this from an investor's point of view. Again, it's not just a number for number's sake, but what insight it gives you into a business, right? Richard?
Yeah, Neil, look, we are using it as a proxy for transitional risk, but I think it's fair to say, with our eyes open to the fact it's a very, very blunt tool, and that not all our emissions are made equal. So there will be some businesses with very considerable carbon emissions that are very easy to abate. There will be others that have maybe small emissions that are absolutely critical to their business process, that are very hard to abate, where the pathway to mitigating that over time will be a key strategic priority for the business. So if I had an extra ability to have some incremental disclosure, some of you may have seen we've been working on this, I'd like to know which of the emissions today are technically and economically feasible to abate now. So technology and the price point of that technology means I can get rid of them today. The percentage of my emissions that are technically feasible but not quite economic, and understand the carbon price at which they might become economic, and then the share of the emissions that are either technically unfeasible to abate, the technology simply is not there yet, or are so expensive to use today that the board is having to have a more strategic debate about, are these operations we may have to stop, are these operations we'll need to offset, or are these operations where we need to actively be supporting the development of maybe more speculative technology to make them economic over time. But we are using emissions today, eyes open to the fact that they are not perfect, but they are comparable across industry. the source of an industry's emissions are pretty similar across the industry. But if I have one thing on my wish list, it's that proven, probable, and currently uneconomic abatement potential of those emissions, which I think would transform the debate we can have with our portfolio companies.
Okay, great. So yeah, it's similar to another point Rommie made, which is seeking to understand how companies are managing them, not just some absolute number. Verity, do you have anything to add on that before I go on to another audience question?
Just to complement what you're saying there, Neil, about quantitative disclosures being sort of an indicator, but the qualitative disclosures, the narrative descriptions of, the assessment of climate resilience and the risk management strategy that a company has, those are all sort of additional qualitative disclosures that can really be insightful for investors, lenders, and creditors really understanding a company's transition risk and management. So it's, yes, ideally we'll have lots of data points and a portfolio management screen full of just quantitative numbers to indicate every answer, but it's not the full picture. That's why there's a mix of qualitative and quantitative disclosure requirements in our standards.
Excellent. All right. Good question here for you, Joe, as someone who manages or helps manage the reporting function. And this is about what kind of team you need. And the question here is, are there specific qualifications that preparers need amongst their staff to facilitate compliance with the ISSB standards going forward? Or indeed, we could say generally with coming disclosure, including climate disclosure.
It's an interesting question. I think it comes up on every conference here, I think, Neil. First of all, what we look for, first of all, there's not a supply of people who have tremendous years of experience with carbon accounting, for example, here. What we turn to our existing employees who are passionate about the topic of climate, who are also quite knowledgeable about our business and the business processes, how decisions are made, who to interact with, how to talk with each other, the culture. All of those things play a very important role. We can certainly reskill a very talented person here. I traded in my textbooks on revenue recognition for books on greenhouse gas protocols and science-based targets. It is possible to do that, and also to be working with networks like ISSB and other organizations to continue to learn. But again, there is a job description that is coming in the future. It's starting to emerge. This is definitely going to be a competency of the finance organization of the future. And a lot of folks are right now, like myself, just in it for about 1.5 to 2 years and really enjoying the opportunity.
Neil, you're muted. Sorry.
Thanks, Richard. Thanks, Joe, for that advice. I appreciate that. And here's a good question for maybe Rommie and Verity. But the question here is from a preparer clearly, and saying that we're in a difficult season currently, post COVID-19, economic recovery, other geopolitical factors taking the attention of many companies. And are these standards not going to overburden or make a situation worse for preparers? And couldn't the implementation be postponed a few years? Could you, Verity, talk to the kind of the pressing need now to complete these standards?
Yes, I think, Rommie, you may have touched on this in your remarks going through the feedback we heard. And on the feedback we gathered on our climate standard in particular stressed the urgency of developing this standard and bringing it to market. And I know I'll try to be quick so Richard can come in also. But the long and short of it is there is a range of real sustainability risks and opportunities that affect business. COVID-19 is one example of a real risk for some and opportunity for others that resulted in certain sustainability decisions and management decisions. Our S1 general requirement standard covers all of the major sustainability risks and opportunities that a company must consider and manage and then discuss and report to their primary users of financial reporting, investors, lenders, and creditors. So that is just one example of a pressing issue that does need to be discussed and addressed. Climate is another one that hasn't gone away because of COVID. Maybe I'll stop there and see who else wants to add.
Richard, do you want to chime in?
I was just going to give a very real world example of working with a portfolio company of ours to conduct what we call an abatement capacity assessment. Their business plan had planned upgrading of machinery at the end of its life. The upgrading of that was going to reduce their aggregate emissions by 5%. By virtue of actually studying the source of their emissions and the quantum emissions across the whole portfolio, they identified an incremental opportunity to invest 1/10 of the amount of money they were spending on the machinery upgrade that would deliver 3 times the decarbonization potential. So I appreciate there's a lot going on in the world today, but companies I think have a real opportunity here to identify what we call their capacity to decarbonize, because it's very difficult to pursue that capacity until you know what it is. And I think starting this journey, understanding the quantum, the source of the emissions, and quickly which ones of those can we deal with now, getting that decarbonization journey started is something I think everybody is going to be grateful they did at the earliest opportunity, rather than kicking this 2 or 3 years down the road.
Great. And, related to that, Rommie, just a last question for you perhaps is when is this happening? And this is one of the most common questions we get is when do we expect companies to start using the ISSB standards?
Well, of course, they can start using them anytime they like, but we're actually having a meeting in a couple of weeks in Montreal to make a decision, to have Verity and her 13 fellow board members make a decision about the effective date of the standards. So the staff will come with some recommendations on what we think makes the most sense, and the board will vote. And so we'll know more in a couple of weeks. Again, encourage everyone to tune into that. But what that doesn't consider is the jurisdictional aspect. And so it's worth keeping that in mind as well. In different jurisdictions, they may adopt at different times. They may also have a certain phase-in period, depending on how they choose to pursue adoption in that particular jurisdiction. But all of that said, the standards will be out, we're saying, in the second quarter of this year, and companies and preparers are obviously, I think, as Richard mentioned, probably encouraged to get started soon, as it will be a little bit of a process for everyone, no matter how sophisticated you are. There's always some work involved in doing something new, and so they will benefit from getting started right away.
And Verity, last word to you as our ISSB member. Any final piece of advice to those listening who are looking to get started?
Yes, start with SASB and TCFD, develop your processes, controls, and get ready. Keep in touch. Fantastic.
Well, we've reached the end of part 2 of 3 in the ISSB Corporate Reporting webinar series. Next week in part 3, we'll turn to integrated reporting, including with ISSB member Hiroshi Komori in Japan, a former head of ESG stewardship at Japan's GPIF, the world's largest pension fund, as well as Tata Steel from India and the Future Fund, Australia's sovereign wealth fund. And if you're listening live, you can register here on the same webpage. The recordings for all 3 parts are also available here. And you're invited to the ISSB Symposium on February 17th in Montreal, which you can join either in person or virtually. So thank you very much to our speakers for part 2, Rommie Johnson from the ISSB, from Salesforce, Joe Allanson, the ISSB's Verity Chagar, and Richard Manley from CPP Investments. I'm Neil Stewart from the IFRS Foundation. Goodbye.